Hey, what's up, everybody? Good morning. Michigan numbers in 35 minutes. The only catalyst today. Market's still showing signs of life. It's as bullish as they can get. I'm telling you. The maps are looking good and bullish. I mean, everything here is looking good and bullish. No fear of this market. Let's get ready here. The S&P front at 301 is overnight hedge pressure. You look at the check. Good morning, everybody. HPs. 267. Market's opening in a couple minutes. Want to get ready, smash that like button before you get ready to get out and on this. Give us some love on the stream. ED band right close to the 53.19 level.
Apple Cash is an easy, convenient, and secure way for your friend. Spend that money right away with Apple Pay. See? Easy.
How about that market yesterday, right? Talked about it selling off, sold off. No trickery on that one. It was a pretty simple to see setup. Resilience predicted a head twisher break. When that happened, everything just all fell loose from there. All right, overnight I was expecting this to retrace and trade a little higher, but we didn't get anything like that. So, yeah. Resiliences are negative, which is good. I mean, positive so far, so good. You can see the market's gonna pull back and do trace some of that gap. Yesterday, you see, positive resiliences go, which is half gap of support, the halfway point. So far, so good. Half gap support. Nasdaq and S&P right here. Looking for the liquidity maps to come through. Make that a little bit bigger. Oh, dang, and there's resistance right there. Okay. This might not actually be a good build. I mean, you get that head twisher break to get now we open above it on Nasdaq. We open above it, tries to close above it, so they get a little bit of a push here. Good setup right there. Hedge break is along the top of bear zone today for both of these. Wait for for S&P. Which Nasdaq will probably pivot around the same area, which is yellow line. Yellow line today. Nasdaq resilience is less than 0, so just be cautious on this one. Okay, so right here, good morning, everybody. So the S&P is gonna be hard to break through here. If you break through here, there's a touch and resistance, and ultimately probably wants to come down here. Nasdaq ultimately wants to stay up in here somewhere. If resilience is greater than 0, we're gonna support again. Resilience can predict head twisher break, so pull the gap. And then that's pretty much on par with that. From here, it's kind of a question where we go. This would be rare to break out of here. So hard to say. Upside more than downside for sure though. Yeah, so there's not a short setup today for like a continual sell-off. I don't see it. Unless resilience starts going negative. So the stock's going to fill their gaps. I don't know if I see that. Not yet. Monthly maps are still strong. Nasdaq bull side stronger, bear side weaker. Good. And S&P monthly map, same thing. Do the greater bull market today. Analysis, S&P. Monthly maps. ED. Bullish. MHP. Bullish. Monthly maps. Still bullish. Bull side getting stronger by slipping down. Bear side getting weaker by slipping down as well. So both sides being in slip down. Monthly map bullish. Greater bull market. So, today, possibly up rather than down. Yellow line in the way. Take note of that. There's the support of the Nasdaq. There's that little breakout I was showing y'all this morning. Little Nasdaq right on hedge pressure. Do we get it? Bull side support there. Resiliences are positive and strong. It does look really good. So we're looking for that. Basically right there. Pop and drop. Hit that yellow line. So it's up. Bull side today. Nasdaq on the hedge pressure breakout. No, I think upside, at least minimum to retrace. So if you take a look at the red lines from yesterday, double check these. Hold on. So this is. Maybe I'll check my calculations here. Okay, so what you're looking at, these are the run lengths, which are, if you remember from the class. So I know there's a lot of lines drawn on this one, but we're gonna move these over to and translate them over here. Okay, so this level right here, 774 and 5307, that's what we call the run length red line, the retrace off of the move, right? From the anchor point to the bottom. So this is your first big pivot. These are the ones that anchor those yellow lines down. So these are your impacts. So these are the ones that created the two big waves down. So the returns, if you are irrational, you're going to have these to play with today and tomorrow. So if you get past this 5307 and start supporting there, there's a move up to there. So the first resistance we've seen has to do with just the futures and the rebalance. And the market's having its first rejection there. I'm going to go ahead and draw a line at these levels to show you. 5307 is the S&P. See how it's right on the point? It's the first pullback we see. That's our calculation, run length. there. Haven't done anything yet. Good morning, guys. Don't forget, smash that like button on the stream really quick. Smash, smash, smash. Let me finish writing on here. Below the stream, click it. Give us some love. Resilience greater than 0 on here. So that's the case for resilience greater than 0. Here, rarest, rare. So expected is to end up somewhere in here. At minimum, maybe it goes up and comes back. But see, the first thing it's battling is retracing the run length here. The first hurdle you see. So if I want to see it get some support off of that run length, I might be willing to take long. So since we're a limited upside case, I'm just going to make sure I get a good long off of that run. Now again, here, that's right here at hedge pressure as well. So it's very similar, equal to where hedge pressure was last night. If you get support here, oops. It's the same setup. This is the rare and then this is the rarest case. So expected. There. Oh, let me did that backwards. Hold on. But yeah, expected. It's expected. Never mind. That's not the rare case. That's the expected case. To stay above hedge pressure. To break hedge pressure is the rare case. Resilience greater than 0. Half gap is likely to be support. So NASDAQ is likely to support and stabilize and hold this. As long as the resilience's numbers are greater than 0, right here, NASDAQ's going to go higher. Very likely. I wouldn't call it a glitch if they have the same hedge pressure, monthly hedge pressure. Sometimes they can. When they have the same hedge pressure monthly or the same, we call that the Atom setup. That is a very, very, very strong pivot. When they're at the same spot, it's even kind of like double power. The Atom loves searching for those setups. We thought I was making a scanner. I think maybe we did make one. Hold on. Oh, we do. We do. We can scan for the atoms right here. The Atom trade. So when they're the same, and when you have a bull long up, for instance, Microsoft, mRNA. No, that's really far away. Let's just do all the bullish ones in general. When they're the same, Tesla. Really powerful pivot. See how the wicks are really, really sharp there, right? So this is going up today, guys. No selling, no sell off yet. NASDAQ just got stronger. NASDAQ's resilience just jumped really high. So some of the tech stocks are starting to recover and move a little bit better. So with NASDAQ holding the fort, the bigger tech going, this is going to retrace and keep going. This is definitely not going to sell off today, in my opinion. Again, I'm just my opinion. Some rando on the internet. Don't listen to it. No. Agree. It's all. We're gonna see. Hopefully, fingers crossed. If you don't mind, give the stream some love. You can hit that like button down below. Question is, 10 points in the S&P is the expected bump. And of course, if you start moving past okay, and people ask what that purple line is. So this purple line is a whole new technique that we've kind of come up with, and it's a whole thing. We calculated it on the day we did calculate it. Is that moving NAS? Let's go, baby. So the day we calculated it here, see how it's kind of, actually no, we didn't calculate it there. Was it? That's the day, oh, that's the day we did put it on here, but where it actually originates from is a whole different story. We did a video on this purple line for lifetime members only. If you're a lifetime, you'll learn newer techniques. This is even bigger. So that's a thing. This thing right here that we waited and waited and waited to get some confirmation on it being something. And if you remember the video, there was a whole lesson on it. Planning is red line again, and it is a strong pivot. One of the strongest pivots I see on these illiquidity pivots. It's insane what it does. And I'll show you guys a little bit of the technique, but do you see this one here? It's a yellow line. It mixes yellow line and contango together. Is everyone here really quick? Why I got you. Right on my chart. We're getting a little bit of a break. Let's go. Bull side slack. Do I tell you the greater bull market? People wake up and look for that. Okay, it's gonna crash. It sold off yesterday. No, yesterday I was thinking I'm gonna get a good ass dip to buy. Yeah, it's in the lifetime videos, John. So what it is it's. Hold on 1 second. Take a look at what we're doing here. S&P is now at 20 resilience. S&P just got a little stronger. Now this is good. Breaking through red linked red line. Good. DD band right up on par next. Very good. Very good. Very good. Very good. Looking great. S&P trying to break through 5307. Looking solid. You have about maybe a little 10-point bump on here. So yeah, this is about as is this gonna get? There's that resistance here. Okay, good. All right, so, all right, what was I gonna say? Oh, what that technique actually is, it's really neat. So there's that expected move here. The S&P not making the fullest rarest move just yet, but breaking through hedge pressure is kind of the rarer case. So this is that big resistance. We'll see if we break it. But this is a nice little scalp. If from here to that red line, that's a decent scalp for anybody. So that's kind of like the questionable pivot from here. If I were thinking that's gonna be choppy, this is probably this is probably the exit target. It starts resisting really hard right here. Nasdaq open below hedge. I'm sorry, that's Tesla. My bad. Let me get back to SPY. But similar thing. Like, it's not a terrible scalp to take and just walk away. There's still some fight here. The S&P does not want to necessarily break through hedge pressure. The expected move is to resist it. So watch resilience is coming back down. So be very careful. That strength is going to die and we might lose it today. So the market is flip-flopping. S&P resilience just went negative. So careful on this one. It might turn around from here. These guys are fighting. Okay, you guys want to know what purple line is? Purple line is a genius. It is a whole separate thing, which I'll demonstrate right here on the chart. Okay, Nasdaq just kind of took a turn for the worse. This is the support. This is the test. If there is a support, it's here and nowhere else. It's there and nowhere else. If there is a support, that's the one. Okay, this purple line is pretty cool. Say that, and I'm just gonna pull some random, come on, drawing tool. Yeah. So say that you have like. Okay. Say that you have like a March. Say you have a June contract. Actually, it's right over here. I'm gonna use the space on here at the bottom. I'm just gonna give you a little bit of it. The lifetime members have a video there. Careful that the resiliences are going negative, so watch out. Like I said, this is the rare case for the S&P. The Nasdaq bump was really good. Kind of pulling back though. So the market's trying to flip-flop to the downside again. So be very aware that this conditions just changed. Again, I'm not in the boat to be shorting anything. There's the greater bull market is there. But that chop is active. So this is being a breakout target to go higher. It looks like we are rejecting those run lengths pretty hard while it's trying to make a run for it. Immediately conditions changed, right? So I would be cautious on this one. Negative resilience does imply that we're here. Well, I did say that rewriting what I wrote, it's rare to break through here. The conditions just changed. Right, so your pivot point is res greater than 0. Right now, dancing at 0. So if you're betting, you're just gambling at this point. Not really clear, but set a clear stop loss on whatever you're betting. If you're betting the gap fills, then you got a stop loss. If you're betting that holds, just, you know, make sure you set a stop loss in here because this thing can go if it turns around. So not looking the super hottest here. Let me double check VIX really quick just to make sure there's no pivots in the way. And I'll explain to you what this purple line is. Magenta line, whatever it is. We ran out of colors. The VIXs have limited downside if there is, or not downside, but there's resistance to volatility as VIX itself has. Resistance is built in. So is this a continuation of yesterday where the market just collapses and dies? I don't think so. I wouldn't be willing to bet on it. Remember, Nasdaq open above hedge pressure, doesn't want to break hedge pressure, but it's trying to. So you can see that the resistances are starting to pile up. So I want to be betting on the long side right now at this moment. It's starting to show signs of failure. So unless there is a Hail Mary that breaks above hedge pressure and holds, the 25% chance that we do break and fall into here is in front of your face. So it's probably not going to hold. So I don't think it's going to hold. Not yet. But what it does from here is it's going to try to fill the gap. So Now, as I say that, the conditions are starting to, like S&P's trying to fight. So you're going to keep your eye on resilience here. The stocks themselves, some stocks are trying, so people are trying to buy stocks, but in all, it's still not doing well. Nasdaq is actually getting worse. The little hope we had of people grabbing that dip, Nasdaq just went to minus 40, S&P's minus 20. So it looks like we're going to get the fill the gap case now. So, wait. One of those days when you can read market like a book. Impressive. Oh. Well, the hard part is that the conditions are changing, right? So it's like we had some strong bull side for a little bit, then it started getting bear, and it's starting to get kind of like meh again. So it's not looking strong anymore, right? Which is kind of neat as a trader is that my convictions are decent that the Nasdaq was going to hold, and it tried to hold, and then once they started losing those conditions, like right here, it's starting to look worse. So I have no active position right now myself personally. And nothing yet. Nasdaq wants to be here. 75% of the time or greater wants to be up here. But it can break if it loses its power. Okay, so the magenta line or the purple line is pretty cool. So say that an event happens in March, and we thought of this. It's like a little stroke of genius that our team has this ability to keep creating new things inside of what we know. Say March happens, all of a sudden you have an event, right? Event creates a rally. And June's contract is trading up here, similar shape, different price. There's contango between the two. Everybody know what contango is? It's the effect when two different contracts. I'm gonna do it. Two different contracts have contango between them when the forward month is valued higher than the reference month. So if this is the front month, let's see, March will be the front month. June is the forward month. This is your futures 101 stuff. This is the current contract. This is the next contract. They're both trading right now, but this is the one that's on your screen that you're trading. The one that's the most volume. This is the next one. And the forward month has a higher value than the current month. It's in contango. The other way around, it's backwardation. So it's priced slightly higher. So its value is slightly higher, but they're trading very similarly. So the charts are going to look the same. So say that. Now we're just waiting for conditions to improve so that I can justify maybe a long on this, but not yet. Conditions aren't improving as much as I want them to. This creates an impact red line. This creates an impact red line. Reference. Fast forward, this one also creates a yellow line. This one also creates a yellow line. So the June one is measured off of that one. The March one is measured off of this one. And it's an effect. The video will go over the details. And this is for lifetime members to go explore that one. But at some point, the March contract expires. And the June contract continues to trade. So you had the March has a pivot that you drew off of the March contract, but the yellow has a pivot that was formed in June while you're trading in June. Once March's contract is expired, March is no longer trading, and now June contract is active. And this is rushing higher. Well, the reference anchor point we always used was when it happened, that front month contract is the reference point. So you use a continuous chart, we draw it. Like right now we drew the ones on the S&P, they're gonna stay there forever for all contracts. Whatever the anchor was is what anchors the price, and that is it. The thing is what we found, it's neater, that the June contract, as it's trading, interacts with both that and this. Now to differentiate the difference one of the two, we're using that kind of magenta line. The contract, when it wasn't the front month, interacts with its own yellow line when it is the front month, which isn't the one we normally talk about. We usually use the one that was created in the previous contract. So once March goes away, its yellow line reference from the March creation point is still a pivot, which is what our normal traditional yellow line is. But the newer contracts will react with their own as well. So it begs the question, is that the continual forward contracts are going to have even more and more and more of those. That could be like, you know, the next one, and then, you know, like you can have this. So like essentially as June is trading, June created one, you know, September created one, and they all create. So the idea is that the month that created its own, it's also a pivot. And it's not only a pivot, but it's the stronger yellow line too, in theory. See this choppy ass market, what it's doing. Explosion candle, can forecast it. Oh, you know what that is? That's the Michigan numbers. That's what it is. Michigan numbers are the catalyst.
When you know the right steps. With a
Yeah, that today. This is, oh, it is Friday, huh?
track, so your team can spend more time celebrating wins. Try it for free at asana.com.
So just a long story short on this one is that this kind of magenta looking line, Marches and Junes also work is really strong illiquidity pivots. So, oh, of how this market flip-flops. That's hard to read. All right, we saw resistance support, and it was looking kind of and then the catalyst bumped us over. That part's unpredictable, fortunately. Just to demonstrate this, is its last little piece of demonstrating this. Do I have it drawn in here? No, I don't have it drawn in there. Did I draw here either? Oh, I didn't draw on there either. To where'd it go? I remember correctly, this particular day here, when March was still the front month, so this is the March contract, and then this is where the June takes over. So while the June, for instance, would have a, I'm just gonna mark it. I don't know if I probably delete on accident. It might have been something like that. So the example I drew on my screen earlier is from this anchor point, the March created a yellow. When you go into the June contract, which was trading slightly higher, the June created one there. So this is the June contract trading now, and this is the June's own version of this line. It's the contango factored in. When you factor in the contango, it's like it's just kind of floating up here with nothing on it, but you can see that it is even super razor sharp, as in, I guess I didn't draw it all the way through there, but there's a pivot there. So when you factor in the other contracts, you're creating a whole different layer of those predictable pivots. Even more so, even today, it's a thing there as well. So it's a whole new dynamic to what we know. John says, is this a culmination of cascading theory? What is cascading theory? It could be, but I don't know what the definition is referencing. What it's doing is it's telling you that all contracts are part of the balancing act. So if people are hedging, we don't just need to look at the forward or the front month contract. The forward contracts are also important. They also have resistances and things relative to them. So essentially, if right now you're trading April, god dang it, March, if you're trading March, June, September, December are all also trading on the equities. So each one of them will have its own pivot. So on the way up, you're going to see that you're going to have pivot points. Some of those other contracts. Now, maybe the next 2 or 3 might be weaker because they're 6 months out, 9 months out. But at least the forward month is worth utilizing as a pivot, because if you draw them, you can see right here, it's really sharp. And even right here, I mean, it's like, it looks like it's just like hidden resistance, right? You can see the wicks around it. And so anyways, it's a new theory that it needs to be incorporated such that we can have even sharper pivots inside of the day. So we can eliminate some more of that noise, and those immediate reversals that seem to just happen out of nowhere could be due to the effects of that. But what would cause that would just be simply if somebody has the same thing that causes the other ones. You know, the dealers themselves get that margin buffer limit, that's an issue. Well, they're not just in the front month contract, they may be a contract ahead. If traders are trading the other contracts, they're on the other side of those too. So I'm sure the effects, because people aren't buying futures like as much, you know, further than the forward one contract that much, as they really having much volume. But the forward month is having resistance as well from that same event. So basically what it's saying is that an event that happens today, the June contract and the September contract are both possibly affected, like instead of just the current one we're trading. So it's a neat second way to create more pivots for yourself. As we dive deeper into contango being affecting this, we're gonna solidify some uniform theory of futures the more we discover. So the answer is contango is a huge deal, and it definitely creates pivot points as well, backwardation as well. Oh, the cascading red lines. Yeah. Oh, John, yeah, that's correct. That was our old theory from back in the day. Yeah, this is that. That's right. That is exactly what that is. I'm sorry, I didn't. Cascading. You mean my cascading theory? Yeah, that is my word. I was like, I've never heard of cascading theory out there. Yeah, that's what I used to call it. Now I remember. God, so many years ago. So yeah, we called it the cascading yellow line and red line theory, which was that you're just factoring in contango into these margin buffer limits, which means that the dealers are getting squeezed on both contracts, not just the first. So there's risk built around any yellow line from any reference point. And how we would physically display that is the hard part, because it's almost like a 4-dimensional graph. Because you'll have like right now, just to kind of show you when I say 4-dimensional graph, what I mean. There's another axis to this. The third axis to this comes off the chart. And each one of these yellows, let me see right here. If the contango between, let's just say like this was March contract. The contango between March and June was always 10. I'm just going to make up a number. Then it means you're going to have one of these as well for June that was 10. If the contango between like, you know, June and the next one, so you like to go to oops, let me change the color here. Let's just use orange. In September. Oops. So like and this chart you're seeing right here, just my history of these. I keep a history of them for research purposes. So that's why it's all messy. This isn't my chart I trade with by any means. So like you'll have, where'd they go? Oh, let me over this one here. Okay. Oh my goodness, come on. Let me just redraw it. The reason it's in our lifetime only courses is because anything that's experimental or new as we're studying, we don't just kind of make videos for everybody to watch and see, because we don't want anything to be focused on that's just an experiment. People can go off and use these things and trade them before we even understand them fully. So we say don't do that. Lifetime people understand, they've been here long enough to know that we're still a research group as well. Do quantitative research here. Different color, September. And then September might have contango of 5. And in December, let's just pick a color. In December might have red yellow lines as well. So essentially, as you go through time, like say that this is what they look like. And from this day, the market always, it does this for like many months. So March expires, June expires, September expires, you're in December's. Okay. So December's, which is the white one, is still active. The one that you would normally see is this yellow one that you drew when it started in March. So this is the yellow line that we would be using to trade with. What the theory is stating that is that because you're in December, you don't have 2 of them. And this is the one that we call our purple line. It's the current front month contract. The current yellow line adjusted that contract's anchor point. And it creates a pivot. In theory, the stronger yellow line pivot than the one you're just seeing. Now, these were all formed in June and we're trading June, so that's the thing. If this rolls into September and we're still flying right here, then each one of these are going to get an adjustment. Which is actually, let's so it's the difference between the 2 anchor points of the contract. If March was there, June was there, they both create their yellow lines. This is AP forward, AP front. So if the difference is 25, then these would get adjusted 25 for. long story just to say that the yellow line gets an adjustment because of the contango. And what we found out, John remembers the old study back in the day, that it's very strong pivot. And the question is that the pivot we should be using? Nasdaq's yellow line, quote unquote, is probably down here somewhere. And that's probably what you're seeing these bounces right here. When the previous month's contract was the one that created it. This is its own reference point. It's not a yellow line by our traditional thing because we leave those. These are the front month creations and they stay there. The active trading month that creates it, they stay there forever. So right now, June is trading against June's yellows, and these are all from the front month they originated. This box connects it to the front month that it was in. That's what the box stays there for, to know where it came from. That's why I draw boxes there. So if we haven't rolled in the September's contract and we haven't touched each of these get a bump to this little purple line, whatever the difference is. So we'll have to go back and calculate that or come up with some way to do it. When we automate yellow lines, there's a way that we can do this. Is there simply would be a little toggle that you would click a button. It would say adjust for contango backwardation. Click the button. This guy would shift and change color. That's all this whole roundabout conversation is to tell you what it's going to do. That's it. You'd be able to adjust the current. And as we're finding out or studying is that this is an effect that needs to be noted. Pretty cool, right? So you always learn something here, but we always come with notes. And basically what it says is that all contracts are important, not just the current one you're trading. And then you boil it down to that and you go, yeah, that does make a little bit of sense. Because all contracts are trading simultaneously. Right now, we're not thinking about what September contract is doing. And it could be trading right here. Like September is doing the same thing. I don't know if it's a contango, I need to look, but September is doing the same thing as well. People are long and short this thing right now. People are long and short this thing right now. So both of them are going to have hedging at certain areas of interest, like their own respective yellow lines. Yeah, John says those deltas still exist, right? And so the idea is that we're tying together a broader spectrum of the market, right? Our current style just looks immediately at what we're trading right now and its own effects on the entirety of the market. But the S&P 500 has futures that are trying to forecast its value, but the different contracts are forecasting its value at different points in time. March is trying to forecast it at March expiration. June is trying to forecast it at June's expiration. September at September's expiration. And right now, they're all trading right now to guess at different points in time the value of this thing, which is why your graph of the S&P and futures has like a hidden third axis, right? This is your time axis in a three-dimensional chart. So I say there's a third dimension there. It's going to have, you know, different effects. Imagine this is just a box. This is projecting towards you. That's why I'm drawing at an angle here. Right. So imagine this is the box that this is like a wall of the box. So they're like the green line is in front of, more closer to you than this orange one, closer to you than this white one. So it's going further back into the page. So you have three different contracts trading at once, trying to forecast different points in time. So this is affecting, yeah, not just delta, but also theta and other things too. Time mechanics. There's arbitrage that takes place. There's people that are trading those contracts against other parameters. Nasdaq just hit its TD band. Nasdaq, the long traders here. If you held through the catalyst, this is DD band right here. Nasdaq is that's the target. Yeah, still no short setup. I didn't call for any short for myself. Didn't see any short. Greater bull market was there. Just choppy longs. Let it do its thing. All right. Oh my gosh. All right, so that's probably the end of the predictable day today. I'll try to guess too much further from here. If you're asking me, would I take a long shot? Would I take a long trade from here? In normal conditions, yes, to its limits. To there, there's an R&R trade on this one, but understand that we got to double check all of our pivots just to make sure. Whenever you have other instruments in the index circle of index products their DD band, that's usually what we call the end of the predictable day. So you know that you're kind of risking breaking. You're trading in the irrational market where DD bands have broken. So inside of here, it's a little risky. When Nasdaq does this, we don't have the stats on what happens outside of DD band. Normally we trade to the band and we're done. We're not as advanced on this as we want to be on understanding the probabilities like we do with liquidity maps. You don't have enough data for this yet. To really be solid on when you hit DD band, you're irrational. What's the probability it stays and goes for each liquidity map? We don't know. But most of the time, if there is, if this tucks back in and reverses, like I think the S&P is not at its final target yet. The first one of the indices that hit the DD band, the lights, when we fix this, the lights will be red. And usually most of us will just walk away at this point in time of the day. You want to understand what DD band is? What is this SMCI? Oh, that was from yesterday. So the answer, would I do it today? The answer is probably not. I wouldn't do it today, personally. I'll just try to see if I can show you what other, here are just some other indices, right? Russell, this is the Russell. Trades the DD band, stop, trade the DD band, stop, trade the DD band, stop. See, it's like the target for the day. Sometimes when you break through it, it'll keep going, okay. Sometimes you break through it, it'll keep going, okay. When you hit it, it reverses that day. You hit it, it reverses that day. So do you see that, like in all cases, while it does reverse, reverse, extend, extend, this one was, it ended. In all cases, it's like half the time it reversed, half the time it broke through, the other time it just hit it and it closed there. So the common denominator is when you hit it or get close to it, you usually want to end your day. It's not worth taking the gambles half the time, so that the other half of the time you blow up. I mean, the chances of breaking DD band and wildly swinging are much rarer than them hitting the DD band and either stopping or resisting. What we notice is that more often than not, it will hug here and stop. What we do notice just by observation is that the breaks in general are not as violent as the reversals that happen. So if they happen half the time, the reversal is bigger than the gain you make. So my buddy calls it picking up pennies in front of a steamroller. Try to squeeze a little bit extra juice on a DD band break, okay. But the other half of the time, and we don't know if it's 50-50 this happens, but the other half of the time when it reverses sharply. So it's not worth being in a trade such that if this does, like if this does break out higher, it's probably going to inch along. If this reverses, it reverses powerfully. Does that make sense, Google? So While it is possible on the S&P to kind of get that trade here, we have to note the entire time NASDAQ is in a spot where it can reverse. And so since the reverse, the resistance from DD band is always so much stronger than the breakout through it. And we can look at all the indices, but they all characteristically have that same. We'll give you a little history on this. So like everything we do here is data, right? So we're not in the business of guessing here. So let's look at some data. Let's just check out NASDAQ in general. How many times when you get the DD band on NASDAQ is it worth getting out of the way or not? Okay. So I'm going to write like an X if it just stops there, an R if it reverses, no, and then E if it extends. So resistance, extend, resistance, or reversal, sorry. Reversal. Reversal. This one, reversal. I'm just looking at the upside ones right now, and I'll come back and do some downside ones after that. This is a reversal. This one was a reversal. This one's clearly a reversal. This one extended through. This one extended through. This one reversal. This one stopped at it. Let's put an X there. This one, it basically stopped at it. It just hugged at it. This one, reversal, right? Okay. Bottom side, okay. Bottom side also reverse. I'm the one that hit. This one extends. This is downside. So NASDAQ falls through here, extends. This one reverses. So as you see, I'm not going to draw all the bottom ones going forward, but as you see, look, reversals 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I'm just kind of taking a quick guess here. 1, 2, 3, 4, 5. Extends or stays. You have 5 and then 2 stays. Now again, this is a small data set. Don't say reverses most of the time. I'd want to be actually no, that is true. That is true. Reversal is not a sell-off. Reversal is it doesn't break the band, and that is the expected behavior. It's supposed to stay inside the band. So if it breaks, it's supposed to tuck back in most of the time. And this is correct. This ratio is correct. So we can just keep adding the reversals. It's the band, extend. Yeah, let's actually keep doing it. Extend. Hit the band, reverse. This one, hit the band, extend. Hit the band, reverse. Hit the band, reverse, extend, right? Let's just keep going. And you can see that like most of the time there's more R's than anything. It breaks through the band and jumps right back in. And keep counting them. You see that you have a lot more reversals than breaks and goes or even stopping at it, right? Very common that you break the band and jumps back inside more often than it doesn't. That is the data we know. But every once in a while, it extends and goes. So when you want to look at the magnitude, just to kind of show you, I'm just going to draw these little boxes. So some of the time you'll be at par, some of the times you'll break through, and that's the distance you got. That's the long you got chasing the long. That's the long you got chasing the long. That's the long you got chasing the long. So I'm just drawing a couple of them. And basically the thing is, if you hold until the end of the day, did you win? Yeah. Now to draw, so an example is we hit the upper DD band and it broke through and I'm still taking a long. Okay. 4 out of 5 days, or 4 out of the 3 months we have here were decent big wins. The rest of these R's though, from the high outside of DD band, are just big. I mean, they're just so big, it's hard not to see that how big they are. Not only are there more R's, but the R distance is significantly bigger than the E distance. Does everyone here in chat? Yes, type yes if you see that. The rejection is, not only are there more of them, but it's on average bigger than the extension you get. So the question is that why we teach you, and you guys might have wondered, like, all these irrational rules and courses we teach you, it's not horse shit. you realize we did our math to understand the reason why there's an irrational rule that we don't trade outside of DD band is because while it can continue to go and rally, more often than not, it does not do that. And when it reverses, it's even bigger than the rally you get. So the odds are completely against you. And that's why we teach DD band is the number one, not the number one, but it's one of the 5 irrational rules that when the light is red, we just call it a day. Currently, NASDAQ is extending. Now, this could be one of those very rare extensions that NASDAQ does this and this and this, and keeps going. And you might be like, holy crap, I missed out. And then you might train yourself that the next time you break through DD band, you don't want to miss out. And the next time you don't want to miss out. But what we do is we understand that if today's the day that does this, that's the fluke. So don't train your brain to say, shit, I'm going to miss out. Because that is the rarest of all of them to break and keep going and fly and pick a huge rally off an event. More often than not, it ends up here. And the problem is the magnitude sometimes is very brutal. If you were to average it all out, it's better to sit out. If you got all that math just tells you, now I can't tell you what to do on today's trading, but it's better, which is why I'm sitting out. Statistically, you see that it's better to sit out outside of DD bands. Do we all understand that? Because when you're outside of DD bands, the only pivots you have are red lines and yellow lines. It's the only ones that we use. Your illiquidity pivots. So it can hit the red line and hang and do whatever. It can hit the yellow line and reverse and sell off like it did yesterday. You don't want to be caught in a yesterday trying to pick up a little bit of gains in a thing like this. You remember yesterday it did that. And so because that's a more common thing to happen, we just train everybody. Once you have that DD band, you sit out. Don't let me be the one to tell you that this was not worth that. So many trading careers ended this day. How many people were like, holy shit, look what it did overnight. Look what it did in the morning session. And most everyone I know was shorting yesterday, right? I was shorting yesterday in the Tradeovate account, but I was definitely not shorting it in my Robin's Cup account. I know that's a gamble. I'm not playing. I don't trade this in any account that I need to show good stats on. I posted my Tradeovate against my other account, the real account over there. I mean, like $7 grand shorting this. So this, unfortunately, this could be the day that this does this. Okay. But the thing is that it's better to miss out on this than to be long on that and be caught up in that psychological drama. So what you do is if you are trying to trade this on the long side, note that your stop loss is going to be right side of the band. So if you start losing the band and resisting the band, get out of the way. Problem becomes bands overshoot, and we also notice that. So it makes it even hard to be actionable. One could say, oh, well, you know what? It tucked back in the band. Okay, let me go ahead and get out of the way. But then it does this, and then it rallies, just like it did there. Because of the overshoots, it's hard to be actionable. So what you have to do is you have to give it a distance. Typically, our standard rule of one strike, 40 points on NASDAQ. Kind of like range, and your stops are kind of like far enough away that you know it's breaking. 10 points in the S&P. No similar. Let's analyze the S&P. Same fashion. Do you guys like when the streams go into a little bit of data crunching like this? To show you that, you know, we got stats to back up our tools, right? We show you the instances of what we're doing. That way you know it's not just some dude whipping up an indicator. We like to see something with lots of probabilities and that the odds are in your favor, and that's the whole point. We made our irrational rules all based on statistics. We just look at the numbers and how many times it did it. Let's quickly do a S&P. Let's count up some R's. Top and bottom. Let's start from here. Let's go from start to finish. This is the last 4 months of trading. Extended, extended, reverse, reverse. Actually, extend, extend. One time it reversed and then it extended that day. X, reverse. This day extended. This day reverse. So you can see it's a pretty good distribution. This is a reverse, then an extend. That one's an extend. That's an extend. This one is a reverse. You're gonna see it's a bunch of R's and E's. All right, it's a mix. Reverse. Extend. Reverse. Reverse. No. Extend. Reverse. Extend. X. Reverse. 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 Extend. It's like some days it reverses, some days it breaks. See, it's like just, you can see how it's just a very good clean distribution. Let's do the whole month. Let's get some real stats. Then reverse. Reverse. Big reverse. That is a X. And almost done. Reverse. Reverse. Reverse and reverse. Okay, let's count them up. Rex. Rawr. T-Rex. Okay. 1, 2, 3, 4, 5, 6, 8, 9, 10, 13, 15, 16, 17, 18, 19, 21. Pretty clean distribution. The S&P, about half of them, and the X, just like where it closed at. X is more like an extend, but I just was saying how many times it closed at, pretty much at the line. 1, it wasn't a reversal. 1, 2, I don't know, did I see any more of those? 3, and I'm just eyeballing this. I might have missed a couple, but just to get a magnitude, 3. So in the S&P, it's roughly 50-50, right? Okay. So, oops. So the S&P is roughly 50-50. Do you understand that? Half the time you break, half the time you reverse. So already, I should tell you that you're flipping a coin, which is why the irrational rule triggers. And then just like magnitudes, right? And again, we can just eyeball some of them. What I like to do is find the best extensions, just to kind of show that the worst reversal is always bigger than the best extension. So not only you're flipping a coin, but when the coin goes against you, the loss is bigger than the gain you get when you play the gain side, right? So these are the extends. They're kind of, relatively speaking, there's some good ones in there. Right. Trying to find the biggest ones to kind of show you, like when you sit out and you're like, oh, these. So the white is going to be your FOMO trade. FOMO, the white you're going to see and be like, oh man, I missed out. Okay. You're going to see those and be like, dude, I could have made and all your friends made all this money and all the people on social media made all this money. But your reversals, you sit out, you'll be thankful that you did, because those are the days that it's quiet on social media. Everyone got it wrong. And while it's quiet, like here, it's loud on social media. Everybody made money and you missed out, and you'd feel like a fool because you missed out. But this is the day that everyone's quiet on social media, including your gurus and whatever. who really lost money, trying to delete their streams and stuff, whatever, right? But you're the one that sat on your hands. And let me pick a different color that's not green. And while you're unhappy here, you're ecstatic here. You're exuberant. You are so happy you did. It's a better feeling to watch the market crash and you miss out on it. Here's some reversals for you. Let me pick a different color. It's not red. You do something like blue. Like, the reversals are no joke. I'm trying to find the biggest ones just to show you how the biggest one is. Here's some downside reversal here, and that. This is the blue is how much you lose if you were on the wrong side of the trade outside the box and it went against you. Here, yesterday was really massive. I'm just drawing the biggest ones. I'm not drawing all of them just so you can understand. Here's a big reversal. Have I proven my point, class? I can't find any super large E's. There's a couple of them that are decent. 1, 2, 3, couple of smaller ones, 4, 5. But the reversals, when you're wrong, are just brutal, right? So the idea is that, so then we came up with the rule, and then we call it the DD band rule. And these are just, you know, obviously observational, but DD band rule is that at DD band, market's random. So what do you mean by random? Well, random is where when you hit the band, what is the odds that it closes higher than the band versus closes lower than the band? And as we demonstrated, just roughly counting, it's about 50-50. So anything that's roughly 50-50, or that we determine is like, you know, not solid odds one way or the other, that's what our definition is random. We call it random because the outcome is 50-50. This is clearly demonstrated here with the S&P. Okay, number 2 is that because it's random, we already tell people when markets are random, day is over. Because you're coin flipping. But 2A is if you must trade or hedge or whatever you want to do, if you must trade small. Flipping a coin. You don't have any intelligence that can go behind this trade other than other tools. But if you know the outcome is 50-50, play smaller because you don't want to gamble on the coin flip going the other way. Other observations that we have is that the reversals are much greater than the breaks. So if you are rolling the dice, you bet on the reversal. Because at 50-50 odds, you'll win more than you'll win as many as you lose, but the reversal will give you more. So 2 different players playing the game. One person only bets on the breaks. Their account goes like this. If one person bets on the reversals, their account goes like this. Because while they have equal numbers of wins and losses, the reversal player is going to win bigger than the break player is going to win. The problem is, why don't we always tell you to trade the reverse? And that's item number 4. Is because the reversal, where it reverses from, is hard, at least where we are now, hard to determine. So if we knew where it would, if we knew we had some reversal points, which we kind of do, for A, yellow line and red line, exception. So all these rules, this is where it's all coming from, by the way. You guys all leave these rules. Why outside of DD bands do we use yellow and red lines to the pivots? Well, they're reversal points. They're normally hard to determine. Most of the time, what you will see is that you have your bands and the market just goes here and goes here, goes here. It's no man's land. There's nothing to pivot off of that I know of. I can't find anything. No red lines, no yellow lines, no liquidity map, nothing. And all of a sudden it just goes and goes and goes and goes and then pops back up from a middle random point in space. So the question is, how far does it go before it reverses? And that part is so hard to determine. So while the reversal player might win bigger, it's hard to know how much drawdown you're going to take to go. So because the break player loses money and the reversal player wins money, the problem is that here's the 0 point. The reversal player might blow up multiple times if their position is too big, because you don't know how much drawdown you're going to take. The drawdown you do take trying to take a reversal is indeterminable. So you can't calculate your risk that easily, because it'll just, like yesterday's case with the NASDAQ, I mean, it just blew right through the top. And how far does it go before it turns around? It doesn't make sense to, when you break the DD band, to bet that it reverses, because you're going to be holding lots and lots and lots and lots and lots of drawdown. The 50% of the time, you're going to lose that trade. The other 50% that you will win, you will take an extraordinary amount of drawdown before you win. So if you must trade, you must trade small to avoid the case of the drawdown or the losses not blowing you up. So if you're trading outside of DD band and you are trading a normal size position, you're a fucking idiot. I love you. So you must trade small because of the reason I just told you. And that's why when the red lights turn on, we say trade small, very, very small. And that means roughly 10 to 20% of your own position. So do y'all like that this is like the videos and all the classes we teach are actually based on these statistics? And this is the reason we do it. Why trade small outside of DD band? Is because the drawdown is enormous. While if you bet on the reversal and you have infinity dollars and you put a reversal bet, you will grow your account. Statistically, your account will go up betting on the reversal every time. The problem is you might not survive a trade. It might blow you up first. So you must trade small enough to avoid that drawdown. But the problem is how small is small. If you don't know the reversal point, you can't calculate how small is small. So you better be throwing pennies at it. Yeah. Okay. As we determine, reversing the market is a better choice. But doing it is hard because you might take too much drawdown. So most of us just sit out, which is what I'm doing. Once you touch the DD band, just call it a day. The safest thing is to avoid that altogether and trade the majority of days that actually just stay inside the band. That's the majority of days. So while it's a less sexy thing to sit out, it's not a sexy thing to be a winning trader. To make a living doing this, to sit in your underwear and do it all day long, not have to commute to work. By being patient and using only when the odds stack in your favor to make a trade. I don't know a single successful, profitable YouTubing trader, which day trades, especially all day, every day, up and down, long, short, long, short. Most people I know that are really good at this don't trade a lot. They spend most of their time finding their setup, taking it, and then if they don't have their setup, not taking it. They're not gamblers. They're methodical mathematicians. They look at the stats like this. So remember, outside of the DD band, if you do have a pivot and you do want to take a trade, then it's pretty easy to take a trade from there. Because when you take a trade from there on those days, you have a solid pivot. So you have risk and reward you can calculate. So another thing is when it reverses back in the band, you don't really know where it reverses to. So an example from yesterday on the S&P. You had a pivot to play off of. So anytime you're outside the DD band, how long can you, where can you trade from? Well, yellow line is certainly a pivot, but as you see, because of the irrational behavior of the market, it does overshoot a lot. So if you're taking the trade, we call it a commit to trade. you commit. If you believe you're taking the reversal bet, you're going to commit and set a solid stop. On the S&P, it's typically, we use a 10-point rule of thumb. So I'm going to commit to this trade to bet that it reverses to somewhere. I got to come up with some pivots for the reward, and I will take a hard 10-point stop.
Is an easy, convenient, and secure way
So in this case, 65 and 75. And that's what I did yesterday, actually.
and lives within messages. It all happens right in the chat.
I pulled that trade up on the stream a couple times, but on Robin's Cup and things like that, I don't trade outside of DD bands. I strictly avoid it because the drawdown is what kills you. Contest, you don't want to deal with drawdown. So in this particular bet, I commit to trade through some shorts at it, had a stop way up here, and the market just collapsed. And so it's better to know where to pivot. If you have a pivot, then betting the reversal is the better strategy. If you want to actually actively trade, you bet on every liquidity pivot outside of DD bands with a hard stop that you do not bag hold against. So pretend that this was where my stop was, it wasn't. But if I just violate my stop just a little bit, then I'm done, and I'm done for the entire day. You get one shot at the reversal. If you don't get it, don't play it again. So one and done. And that's a good rule. So what most people here actually do in actuality is they will bet on every reversal that bumps into a yellow or red line outside of the band, because it's a really amazing pivot for the reversal. So anytime you breach the band and extend, and you want to take the more violent reversal bet, you just take the opposite direction with a hard stop that you do not violate or move. This is a great example of that. There might have been some red lines here that I deleted, but the red lines are the same. Do you guys see this when Google and all those people are asking Maz? Carmel, you guys see that? So outside the DD band, reversing off the illiquidity pivot is always a great trade with a small position. Always, always, always. The reversal is typically, and as we know with the S&P, it was about 50-50. With the NASDAQ, we see a little bit more reversals in NASDAQ than we do in the S&P. But again, that's anecdotal. Here's an example that you broke through, and what if I did a 10-point stop? This guy broke through. If I longed here with a 10-point stop, I made some money, and then I stopped out, and then it reversed again. Look how complicated that would have been. That would have been heartbreaking. So you see how the reversal is trying to happen here, and then it fails and I stop. So if that was 86 and 76, check this out. You do not violate that stop. So if I were to long here to bet that we reverse in somewhere or higher, then your calculation of your reward is that your risk is 10 points. So at minimum, you bet that you return to the band and maybe close out, hold a runner. So from 86 to about 5104, give or take, or it's about 16 points, the 10-point stop. So it's greater than 1-to-1. It's a good trade. My stop is here no matter what. And then just check out how bad this was. 76. It fell almost all the way down to 60. It fell another 16 points before it came back through. You don't want to take 16 points of drawdown, so don't violate your stop. If it hits it, get out of the way. So this one wouldn't have been a winning trade, but you'd have fixed your loss. So if you're outside those DD bands, you must find a pivot. You must understand that it will likely overshoot. The reversal's the better play, and you must never violate your stop and don't make a second attempt at it. And you follow those rules, you can be part of that hype crew that gets in on those runners. Sorry, you're not part of the hype crew that gets in on those runners, but you are part of the loud, small subset of traders on those quiet days when everyone reversed. You're the only one that caught it. Yesterday. That I banked pretty hard yesterday, and that's a pretty simple. And I won't lie. When we lost here, I added to the position, and I don't normally do that. But I was like, what the hell? Fuck it. I had a small position. And then once we break through, I just double down. Yeah, so because yellow line was here, it's a great setup. So this is why we keep a history of these, because every single day you look for that. Here's a great example. Do we all see that today's example? We have that. First of all, you've got this in the way here. But say that the S&P breaks out today and goes here and hits that. Let's build a case. All right. So if I'm betting on the reversal, my reward is from 27 to about 18. About maybe 9 points of trade. I want to get at least that. My rule is I need a 10-point stop, right? 10. So not only is it a 50-50 shot of getting the trade, my risk and reward is also 1-to-1. It might be worth taking a scalp and nothing more. Because of that, I don't want to be in trades that are losing as much as they're gaining half the time. I'm just flipping coins at that point. I might move my stop closer and actually make it 5 points just to actually have adequate risk and reward. I might give myself a full 10 points of overshoot. So some 10 points is my rule of thumb. I always pull it in to force this to be greater than 1-to-1. So that's almost a 2-to-1 trade now. So if we break the DD band today, which is looking like it possibly could, I'm gonna look for that. And I can take a scalp to there to stop. Those of you that are more advantageous shorts might want to hold it and trade longer there. Those of you who are advantageous longs, just remember, if you're taking the long side, it's the same rule in reverse. You set your stop and you do not violate it if it's lost. Reversal, the long side, is a painful reversal to play with. And because it's random, you know, it's really hard to say who wins the day. And if anyone out there tells you they can predict the stock market and they know the answer there, they're full of shit. Here you go. Nasdaq's coming right up. Here. Let's just watch it before I get out of here. I'll watch it with you. Okay. Nasdaq is a 40-point roll. 910. I don't ever short early. If I were to short, example, again, not investment advice, don't follow my lead. It's example study. If I hit here, I'm looking for this trade right there. My stop is 40 points. 40 points of loss to gain. $62 points of gain. The R&R is definitely there. You'll see how this works. So what? Let's watch like the moment you tap that red line. Let's watch it. Why don't I take a stab at it in the trade rate account? Oh. So I don't ever jump in sooner than I need to, but let's watch it. Just to go a little further, let me double check everything. Okay, so SPY's at bear zone. And if there's anything in front of it that also can act as a pivot, you got to pivot right here. There's your bear zone on SPY. Nasdaq has nothing in the way. The Nasdaq by proxy might start selling off because of bear zone SPY. Right, it's very close. I should find any pivot right now. So the question is, Nasdaq is outside of DD bands right now. Okay. SPY has a pivot right here. Nasdaq has a pivot right there. That pivot's in the same spot. Okay. SPY's right at its bear zone top. So that's really that limit on SPY. So it's trying to resist there, right? You guys see that? I'm not going to cheat myself early. Let's let it tap. That's it. We're looking right for about 70, right? This will show you how, this is just hopefully to scare you to see how hard it is to trade outside of DD bands. We'll show you. I'll show you what it is. I'll show you how hard it is. Yeah, right about 870, give or take. We'll also know that the SPY is also battling its resistance at bear zone right now. So, and you also have S&P yellow line right there as well. You have a lot of targets to play on right here. There's that last little bump. S&P is gonna make a run for it. See how it's trying to fight off, right? Nothing yet. Nothing yet. Again, not cheating myself. There it is. Let's hit it. That's it. See that? Don't ever cheat yourself. Let it touch. Look at that. Look at that. I'm getting faked out by this. Okay, now this is it. This is the trade, right? So let's see what it's like. Let's just pretend that okay. Just pretend. Let's simulate the experience. Okay. 40 point stop is what, 910? Target is here. So you have a big wide range. Watch what happens. We're going to simulate the experience that you would have. Let's go ahead and put on a tick chart and let's just get really dirty right up on it and watch and see how crazy and choppy this thing can be. Let's watch it. Watch the violence from here. Let's see. I got in a trade on the TraderBait account. My entry point is 816. I got 18,869 a quarter. I get filled right here. Not bad. I'm just gonna have a crazy. So the question is, you're gonna get to see why, if there is a trade, this is the only place it resists from is here. You see that resistance? You see it? Now, it doesn't mean it's gonna go. Remember, half of the time it doesn't reverse. Half the time it keeps going. If there is a reversal, it is only going to be from here and nowhere else. It's the only place it's going to pivot from. that I can predict. It may pivot other places I may not know. And we'll see. And that's where your stop loss is important. And when it loses quick. And now you see how random it is. While the odds are in my favor, this one happened to be a loss. Don't violate your stop. A tighter manual stop. Well, right. That's what I'm saying is you use a tight stop. Because it's choppy, you can't use like a very tight stop though. That's the problem. So see that one, simulating that one is a loss. I'm out. I completely closed on that one. So, and no more trading anymore, right? So as we simulate the experience with you guys, and watch what happens. It could very well just turn around and reverse. But do you see how this was the resistance? And I say if it's going to resist, it's here and nowhere else. And that quickly failed. And so I'm glad we walked through the losing case scenario of that particular trade. Do you see how here that it got very rapidly moved, right? So that's exactly what you're going to expect. It's not going to just inch its way over there. It's either going to reverse or it's going to fight. And go. So reverse or it's going to fly. So this was the resistance if there ever was one. And now it failed. Now it failed. Now I'm not going to come in here and say, okay, well, maybe let me go ahead and try to short from here. Maybe this one would work, and maybe that one would work, and that one would work. Once you fail, you had your R&R, you set it up, call it a day. Wait, hold on. Wait, that wasn't 40 points. Is that? Wait, it didn't go 40 points yet, did it? Is my math off here? Oh, 9-10. I'm so stupid. Don't listen to me. Stop is here. 9-10. I just closed my position out early. What's wrong with me? Whatever. Okay. Either case, technically speaking, that's where the stop should have been. What is wrong with me? Why did I? Yeah, I just pushed the close button right here. Oops. Oh, well, okay. So technically speaking, this is where my stop should have been. Yeah. So you also look for other pivots as well. Bull zone, top of bull zone, things like that. Do we see anything? The S&P has a pivot there. But case in point, you guys see the demonstration, right? This was a losing setup. The reversal I wanted happened, didn't happen. Actually, my stop should have been right about there. So it's more like the reason you don't use tight stops is because it is choppy outside of DD band. Once you get outside of DD band, the volatility picks up sometimes. So that's technically the one strike distance on here. So like I said, it could go here and then I would have stopped out there, but whatever. I stopped out smaller than it went out.
Oh, so this is the one where the pivot, you took the trade, it didn't work.
But every single time on those resistances outside the band are the trades to take. So this is a simulated experience, and this would be the losing case. Just click the button, get out of the trade, and then walk away. Couple symbols out, you can't win them all, and then there you go. So, but what I don't do is I sit here and say, well, maybe it'll reverse here, maybe it'll reverse there, etc. Don't do that. So let's pretend I was still in a trade. that's where the stop would be. So the reward is here for me, and the risk is here. This is irrational trading. We usually tell people, you know, if you're new, sit out, sit out, sit out. Don't trade out here. If you know how to manage your position and you know to calculate this every time to make sure that when you are in a position, you don't blow up at your risk to get your reward. You must always be good at managing positions out here. You must know that if you're trading off of something like this, you are committing to it. You just get in, set your stop, set your profit, set it and forget it. You're going to either get the loss, get the win, but you're going to bet on the statistics riding you in your favor. So that means that you can't accumulate a bunch of losses, blow up the account. So your position must be small enough to do that. Very, very small. 10% of what you normally will trade. Say 10 to 20%. If your normal is 2 futures contracts, if you normally trade 2 minis, example, then on these trades, you're trading 2 micros, okay? Do not violate the position size rule. Unless you are meticulously calculating your risk, you're going to stick to your guns and trade a very, very, very small, if you ever even touch outside DE bands. This is how violent and crazy it can get. Okay. What else was I trying to do right now? So here we go. Now this is the example on this trade. Hit the stop, done. I'll see that. So in this particular sense, if I took a small short and stopped right there, no hurt. But I don't want to keep trading. I keep betting from here. And then what happens is random from here. You see how that works? So this would be one of those days that, in the statistics of things, this is one of the ones that extends. This is the E today. And there really is no reversal target inside of here. I don't see one. So as it's continuing to move beyond where my stop was set, just not, oh, actually not yet, right here. This is where my stop would be, 9, 10, 40 points. I somehow can't do math today. 70 plus 40 is 9, 10. That's where the stop would be, hypothetically, not yet. So, it's 1 strike distance away from here is the rule of thumb. And I'd be inching up against my stop. If that happens and I stop out, and it pops back in and starts to fall, I don't come in and say, oh shit, let me get back in on that. Right now, the trade is technically a failure. Now, huge amount of drawdown, not really if it's a very, that's why this particular trade you trade very, very small. Let's imagine you lose 40 points. Normally you do 2 minis, right? I'm just an example. If I do 2 minis, every 10 points is $200 on NASDAQ, okay? That's 800 per contract, that's $1,600 loss, okay? Let's do the math for you really quick. It's 40 points times $20 a point times 2 minis. Okay, $1,600 loss to make a, here's just doing the math here, roughly a 60 point gain, just about roughly $2,400. So the risk I was taking was 16. The reward is 24. That's a lot of swing in an account. I used to gamble on those things. So I were to trade 2 micros instead, the rule of trading small, then I'm playing for some odds of making 240 and losing 160. That's much more palatable, right? That's the reason to trade a very small amount to here, because these swings get violent and you can't trust yourself to not be a bag holder and keep stabbing at it. So if you trade very, very small, you can see that if your normal up and down is a couple $1,000 a day, but when you're irrational and you still feel the itch to trade, just trade smaller. You're playing in no man's land. You're playing when irrational. It can squeeze you really hard, so play really small. And that's the whole reason position risk management is like really the cornerstone to being good at trading. Knowing when to bet, when to fold, how much to bet based on your odds. And this is a great example of the reason we play small. I'm not in here jumping in on 2, 3, 4 minis trying to trade on this. Blowing up thousands of dollars here. I know the circumstances are irrational market. Let's play small. And oh darn, I lost $160. No big. Oh hey, cool, I made 240. Also no big, but hey, I also want to trade. And that's kind of the mentality that you have. If you know certain regions you trade differently, then that's basically it. And that's all you have to do. Now the S&P, now you have a stab at the S&P. It's got its own thing here. Now let's see the S&P. You could maybe repeat the trade on the S&P. The S&P has its red line. Let's watch that one. Hypothetically speaking. Like, you know what? I'm not a NASDAQ trader. The NASDAQ trade failed. But maybe they'll all pivot because the S&P is going to pivot. Okay, let's do the same in reverse. 37. What's the win here? 19. Okay, so this is... So the S&P is a 10-point stop for a 9-point gain. It's kind of like right at 1-to-1. I don't like that. So I would move my stop in arbitrarily, probably half the distance. And get a 2-to-1 trade, throw some micros at it. So the more advanced thing is that if you know that NASDAQ has its one, now again, I'm teaching, this is lesson number 2, is that NASDAQ has a pivot here. By proxy, S&P does have a pivot there where your NASDAQ stop would be. So one may take a couple of micros here, and then maybe a couple micros more here and extend your stop further because the S&P is now going to have that same battle. So if you know you can take a second entry, which is shorting here and here, again, very, very, very small. You can double down here and that 160 becomes a 320 loss and then that 240 becomes a 480 win, right? You're still playing small-ish, but you know that now S&P has that same question of, okay, here's a pivot on the S&P. Well, the NASDAQ failed it's likely going to be yanked down if the S&P fails here. That makes sense to you guys. That is, yeah, so that's how that works. So, oh, darn, I lost whatever I lost, right? Okay, so what about now? There's another opportunity here. If you still want to take a stab at it, then you get a second opportunity to take a stab at it. And Russell, you can do the same thing with Russell. And remember, each time, each trade is separate, each trade is different, each trade has its own analysis point. Here's the reversal, or here's the resistance, resisting, as red lines tend to do. So this is like we tried with NASDAQ, it didn't work. Let's try at the S&P. What's it doing? I'm not actually taking this one, but just hypothetically, let's pretend that I am. So I'm not touching anything. No trade for me. And so when you breach DD bands, you see how I'm no longer talking about resilience. I'm no longer talking about liquidity maps. I'm no longer talking about DD. Whenever you're outside DD bands, you throw everything away. You're only trading illiquidity pivots at this point. Markets are irrational. So liquidity pockets, liquidity map, hedge pressures, monthly, none of that stuff is used outside of DD bands. That's rule number one of those things. When irrational, you throw all of this out. You turn all of this off. So at this point in time, there's no particular... All right. You have any questions for me? What was the percent of ending in bear zone when starting a bear when irrational? In all cases, irrational or rational, all cases total 75%. Yes, you also have that odd working with you. So here's the S&P trade off of that. And see how that reversal is coming right in, right on point? So the question is this trade going to be the one that does work? Nasdaq one failed here, the S&P. So like once you break the impact, you delete it, right? It's gone. Sinker is gone. Nasdaq even has another one from yesterday. The S&P has another one from yesterday. So some days like yesterday, you actually created two of those resistances. But you can see that our red line is pretty strong. If you guys don't know that technique, sign up and learn the videos, right? BetterRockStudio.com. Make sure you sign up. The 1 month trial. You can check out what we do, what we teach here. This is that particular resistance we talk about. Is it going to work? We shall see. That's basically it. So let's talk about it in chat. I'll head over to Discord. Stream is 20 minutes past due. Time to get out of here. We'll touch base and see how that turns out. And I will catch you guys on the flip side. See y'all tomorrow. Nice, crazy, clean, reversal, irrational day. No short signs today. A little bit of a scare at the start of the day. Once Brazilians flipped positive, the markets just survived that and then stayed on its own. I mean, a little bit of a scare. Things try to rectify themselves. Oh yeah, what's the easiest? Oops. This is the easiest start, but we're okay. Now let's click on here. Once resilience right at its way here, then market is kind of good. So yeah, it chopped for a little bit. Open in bull zone, tend to close in bull zone. That's one of our rules. Open in bear zone, tend to close in bear zone. That's also another one of our rules. Hedge pressure breaks are more rare than hedge pressure support, so opening above tends to close above. Opening below tends to want to close below. So now you have two different conflicting things. The S&P wants to be here and here. The NASDAQ wants to be here, here. So a pullback on the S&P and NASDAQ will still satisfy both rules. So keep that in mind. The S&P wants to be here. NASDAQ wants to be here. So is that DD trade possible? Possibly. We'll see. Yes, you watched the last 30 minutes. Shows gold. Thanks, man. Appreciate it. You guys, whenever marketplace stuff dies down, I get back to this is the Zoom calls. If you guys are the members here, remember the Zoom calls I would do? And marketplace just kind of zapped all my free time in the day, but daily Zoom calls are all like this. It's like positioning and I got a meeting in 30 minutes anyways. Okay. Love you guys. We'll see you later. Don't forget. Join the program. Check out the Discord. We'll see you later. If you haven't done the trial, 1 month extended trial, check it out. Link in the description below. Love you guys.